Hi, this is Mike Larson from Money and Markets TV. Here's a little riddle. What do you get if you combine low-volume stock rallies driven by nothing fundamental, a steady upward move in bond prices and decline in interest rates, and a surge in hard assets coupled with a relentless decline in select currencies? If you've been studying the markets for years like I have, you know that these clues point in one direction: quantitative easing. Now, quantitative easing, or QE, is just Wall Street jargon for money printing. We've seen two rounds of it here in the US, first from November of 2008 through March of 2010, and then from November of 2010 through June of last year. QE1 caused every asset on the planet to levitate for months on end. The exception was the US dollar, which fell hard. And QE2 had a similar but more muted effect. Now, over in Europe, central bankers and politicians griped about the impact of the Fed's money printing on commodities and the threat a falling dollar posed for their export industry. More recently, several policymakers publicly disavowed money printing as a strategy to combat the sovereign debt crisis. But their actions speak louder than their words. Late last year, the European Central Bank conducted the first of two planned long-term refinancing operations, or LTROs for short. The scheme flooded banks with 489 billion euros of cheap money, which they were strongly encouraged to use to buy sovereign bonds. The second LTRO is scheduled for next month, and there's talk we could see 1 trillion euros or more in demand. As a result of this and other moves to combat the debt crisis, the ECB's balance sheet has exploded from under 2 trillion euros to nearly 2.7 trillion in just 6 months. Viewed in this way, it's clear that the ECB is pursuing the same strategy that the Fed did, just in a more roundabout way. Now, the definition of insanity, according to Albert Einstein, is doing the same thing over and over again and expecting a different result. But it looks like central bankers the world over haven't gotten the memo. Despite the failure of 2 rounds of quantitative easing to stimulate the US economy in a lasting and meaningful way, and the failure of 2 rounds of QE in the UK to accomplish anything either, it appears that Europe's expecting its version of QE to work where the others didn't. But if history's any guide, it too will fail miserably. What the strategy likely will do, though, is inflate the asset market short term and drive the value of the euro currency even lower, just as the Fed's QE program drove the US dollar down. So make sure to keep that in mind when you're choosing investments over the next few months. I'm Mike Larson from Money and Markets TV. Thanks for watching.